So, Daily Trader TV, episode 7, 24th of January 2018. So, the next question that's been put on the channel is: would you mind showing the primary strategy that you use to trade? And before I get going, just be aware of the disclaimer. I'm not qualified to give you personal financial advice, so don't ask me about individual stocks, etc. I can't advise you on that. And don't buy or sell anything that I use, and be careful of leverage. So, that being said, quick look at the portfolio. Still just off all-time highs, which is completely normal. If we go and have a look at what's going on today. Filter group, fine. Photo me, come back into the hundreds. DPEU, we had a trading update yesterday, market seems fine. CAML, just come back in slightly. Boom, fine. RFX, fine. Jim, just flagging out. Be nice if it just flags out a bit more and breaks to new highs. EQN. What I'm hoping is going to happen now is that we move above this pivot point. So I want to see that this now comes off in this direction, starts trending up. Cake broke out above its pivot point, hopefully. Hollywood Bowl flagging out. On the beach, trying to make a new high. Overall market looks fine. US overnight, new highs. Oil flagging out. Quick look at cable. New highs for cable, 140. I think I've mentioned this before, but this is what happens. People get hysterical, think the world's ending. And here we are, back at similar levels to before the Brexit thing happened, and cable is looking pretty bullish, in a definite uptrend against the dollar. So, going back to the question, would you mind showing the primary strategy that you use to trade? I've got no problems doing that. It's not a secret, even if I told you everything that I do. There's a hell of a lot more to it than just understanding what it is that I do. But essentially, I operate on statistical edge, sometimes called positive expectancy. So I'm looking for a statistical edge against the other players in the game. 90%, at least 90% of people that trade any financial market lose, and that's because they don't understand this important rule. So write this down. You have to know your statistical edge. So no one trade matters to me. I've got no interest in any of the trades that we've looked at. So I couldn't care less about any of the. I can't tell you which of these trades are going to be winners and losers. I've no idea. So my system is that I have a 50% chance of being right over the long run, and my winners are typically 2 to 3 times bigger than my losing trades. And the reason that 90% of people lose money trading is because they've got no strategy and they don't know what their edge is. So I've just told you my edge. 50% of the time I'm right, and when I'm right, my winners are at least twice as big as my losers. So what I'm going to do is show you a 10-15 minute video, and I suggest that you watch it with a pen and paper, make some notes, and then drop some questions into the comments, and I'll use that to generate more videos. Look guys, at the end of the day, I've been doing this a long time. Most of the information that you're ever going to learn out of books or paying for fancy courses, I can give you for free. But you're only going to get that information if you start asking questions. If you don't start asking questions, what's likely to happen, or what will happen, is I'm going to make 90 videos. And regardless, even if nobody watches, even if there's crickets, I'm going to make 90 videos and leave them on YouTube. What's going to get past the 90 videos is if I think people are driving value from it. And the only way you're going to derive value from it is if you're asking questions. Doesn't matter how silly they are. I don't need to tell people who ask the question. The vast majority of people who are watching these videos are learners. So there are no daft questions. It doesn't matter what the question is, just ask. If you don't want to, that's fine, it's not a problem. But obviously, we won't be sat here in a year's time still making videos if you already know all the answers to what I'm showing you. So let's get on to the video.
Income, the way I build my wealth is by trading the stock markets. Some people look at me funnily and they go, hey, isn't that gambling? Doesn't that depend on luck? Isn't that risky? And I'm here to tell you the honest truth. And the honest truth is that trading is gambling. Absolutely. The stock market is a giant casino. It's a legal casino. So let me ask you this. In gambling, who always loses money? The answer is the players always lose money. See, as a player, sometimes you may win or lose in a short term. You may have a winning streak based on luck. But luck doesn't last forever. Luck will eventually run out, and eventually players will always lose everything they have. But who always makes money in the end? The answer is the casino always makes money in the end, right? I'm sure you've heard this phrase that the house always wins. The casino always wins, no matter what happens. Why? That is why the casino would give away free food, free entertainment, free drinks, just to attract people to play. Because the more people that play, the more money they make. Now, how do they do that? How can a casino ensure that in a game of chance, they always make money? And I'm here to share with you the secrets of the casinos and to show you how, as a professional trader, I set myself up as the casino. And that's how I always make money in the end. So how do casinos guarantee that they always make money in the end? Well, what they do is they rig the games in such a way that they have a statistical edge over the market. Or they have got a positive expectancy while the player has a negative expectancy. So here's how it works. Let's take a typical game called roulette. So in roulette, what happens is you've got a giant wheel, right? And this wheel is made of numbers. And you've got this spinning device, right? When you throw the ball and the ball will spin, it will land on one of the numbers. And what you can do is you can bet which number you'll land on. Will it land on an odd or even number, a black or red number? Okay? So a common bet would be to bet on black or red. So for example, this is a red number, it's a black number, it's another red number, and so on and so forth. Okay? Now here's the thing. Many people think that if they make a bet with the casino, they've got a 50-50 chance of being right. Well, they are wrong. It's not a 50-50 chance because the casino has rigged the game in such a way that there are altogether 18 red numbers, 18 black numbers. Similarly, 18 even numbers and 18 odd numbers. But there are 2 green numbers, which are the 0 and the 00. These are green. Okay? Therein lies their secret. So, this is what happens. For example, if you bet on black, what's your chance of being right? Your chance is 18 because there are 18 black numbers, out of not 36, 38. Right? Because there are 18 black, 18 red, and 2 green numbers. So, and the casino's chance of winning is 20 out of 38. Because if the ball lands on the green, the casino wins as well. Okay? So if you work it out, the player's chance of making money is about 47.3%. The casino's edge is 52.7%. So, what is the casino's edge over the player? The casino's edge is 52.7 minus 47.3. That's 5.4%. There you go. So the casino has got a 5.4% edge over the player, and that's how they make all the money at the end of the day. So what does 5.4% mean? It means that in the long run, over many bets, for every $1 that people bet, in the long run, the casino will make 5.4% of that money, which is 5 cents, 5.4 cents, right? And if $1 million are bet in the casino will make, on average, $54,000. So the more people that play, the more people that bet, the more money they make. That's what happens. Now, let me explain in another way, right? For example, if you got 1,000 bets, and each bet is $1,000. $1 million is bet, right? $1 million bet, right? Great. And statistically, out of 1,000 bets, the casino's going to win 52.7%. The player's going to win 47.3%. Right? So that means the casino will win 527 bets and lose 473 bets. Right? Now, each time they bet, they win 1,000. They lose 1,000, right? So this is $1,000. So they make 527 grand. They lose 473 grand. Right? So this minus this is, you got it, $54,000. That's how it works. So now I'm going to teach you as professional traders, how do we replicate the business model of the casinos. But first of all, let me tell you why most people who trade the stock markets will all lose money. I repeat, 90% of people who trade stocks will lose money, just like the players who go to a casino. And the reason most people will lose money is because they don't have a plan. They don't have a strategy, right? They buy based on rumors, based on emotions, based on opinions, based on tips, right? So to most people, when they buy a stock, what's the chance of them being right? 50-50, right? It's random. It either goes up or it goes down. Now you may say, Adam, if it's 50-50, it's not that bad. Well, actually, it's worse than that. Why? Remember that when you go to a casino, you bet $1. If you lose $1. If you win $1, right? So you're risking 1 to make 1, correct? But for most people, when they go into the stock markets, the trouble is because of their emotions, they lose more when they're wrong and they make less when they're right. Let me give you an example. So most people, what happens is if they buy a stock, say at $10, right? They say it's going to go up. Yes, I believe it's going to go up, right? And sure enough, it doesn't go up, right? It goes down, and what happens? Right? They say it'll come back tomorrow, it'll come back tomorrow, it'll come back tomorrow, and they keep holding onto a loser till it loses big. They get a big fat loss. Yeah? And most people, when they buy a stock and it starts going up by a bit, say $11, $12, say, they made some money, and they say, let me take my profits before I lose it, and they take small profits. Okay? So most people, because of instant gratification, the moment they make a bit of money, they want to sell and take it off the markets, right? So the instant gratification causes small wins, small profits. And the fear of losing money causes people to not want to cut their losses. So when they make a loss, they say, it's going to come back, let me give it some more time, I'm going to have hope, right? And a small loss balloons to a large loss. So as a result, most people win small, they lose big, and they're right half the time. So you do the math. In the end, they always lose money. Now, as professional traders, we always make money at the end of the day. How do we do that? We replicate the business model of the casino. So I explained how the casinos rig the game in order to have a statistical edge over the player, right? Now I'm going to teach you how, as professional traders, we rig the games. We rig the stock market. Legally, of course, right? So like I mentioned, most players, when they buy or they sell a stock, it's a 50-50 chance. It either goes up or it goes down. But as professional traders, what we do is we study the markets. We look for repeatable price action patterns, or we call it technical analysis. And by applying these price action patterns that are repeatable, we are able to enter when the statistical edge is in our favor. So let me give you an example. When you look at the stock market, basically there are three things that could happen in the stock market. Okay, the market either goes on an uptrend, it goes on a downtrend, or it goes sideways. Okay, so I'm just going to focus on uptrend and sideways. I'm going to do this in another video. All right. So if I notice that a stock is on an uptrend, for example, now on an uptrend, you notice that a stock doesn't go up in a straight line, right? It goes in wave patterns, right? It's what we call it impulse, correction, impulse, correction, impulse, correction. Okay, and oftentimes when it corrects to a support level, we call this a moving average or support level. And you see this very repeatable wave pattern. It hits that level, it bounces up. What do you think is going to happen? Duh, right? It's probably going to go up, right? So as professional traders, that's when we buy. Because on an uptrend, when the price hits a support level after a retracement, there's a high probability that it's going to go up. Now, is it a guarantee? Is it 100% it's going to go up? Of course not, right? It could still go down. But when you enter at these repeatable price patterns, the chance of it going up is more than 50-50. It's not 100%, but let's take it as a 60% chance it's going to go up. Okay? Or even 55%, whatever it is, right? Of course, there'll be a 40% when it fails and the trend reverses into a downtrend. Okay? So say 40% you lose and 60% you win. Okay? What's your edge? Your edge is you win 60%, you lose 40%. Your statistical edge is 20%. That's better than the casino. The casino's edge was only 5.4% and they make billions or hundreds of millions, whatever it is, right? But as a professional trader, your edge can be 20%. Now, even if you are right only 55% of the time, some people say that's no big deal, and you are wrong 45% of the time, hey, that's still a 10% edge. So being a professional trader is better than owning a casino, if you think about it that way. Now, here's the other best part. As a casino, when you bet with the players, you're betting 1 for 1, right? If you lose $100. If you make $100. But in professional trading, we never bet 1 for 1. We always bet at least 1 for 2. In other words, we always risk 1 to make $2 or more. How do we make this happen? By placing a stop loss to guarantee how much we're going to lose and a profit target to guarantee how much we're going to win when we're right. So let me draw this again. Now, in this case, let me show another example. In this example, the market is going sideways. Usually when the market goes sideways, it's in a range. Like that, it's in a range. Right? So it hits what we call resistance, support, resistance. So you have to see this repeatable price pattern. It doesn't happen for every stock. It doesn't happen every day, but when you see it, you can trade it. We only trade when we see a repeatable price pattern. All right? So for example, say this is $10 and this is $15, right? So the price hits this support level and what do you think is going to happen, right? Duh, it's going to go up there, right? So we're going to buy here. Again, is it a guarantee it's going to go up? No. It's just a probability. It's better than 50-50 chance, right? But based on its repeatable price pattern, say the chance of it going up is 60% chance. And the chance that after I buy it dies, it's a 40% chance. Win, lose. Now here's the difference. So say I buy it at $11. what do? I have to place what I call a stop loss order, a stop loss that says, hey, if it goes to $9, sell it immediately. I cut my losses, right? So if you do that, how much will you lose when you're wrong? You will lose $2. So by placing a stop loss, you guarantee how much you are going to lose when you're wrong, right? And you just have to make sure that the distance from your entry price, your buy at 11 to the top of the range, say this is 15, right? So if it goes from 11 to 15, how much you make? You make $4. So you're risking $2 to make $4. Or another way of saying it is you're risking 1 to make 2. You're risking 1 to make 2 with a 60% win rate. And that's how you rig the game of the stock market. Now, if you do this consistently, in other words, out of, for example, 100 trades. Now, I do about 20 trades a month on average. So it takes me about 5 months to do 100 trades, okay? Out of 100 trades, again, my win rate is, say, 60% win rate. So I'm going to win 60 trades. I'm going to lose 40 trades, okay? Now, each time I lose $1, right? Or whatever I'm willing to invest or trade. When I win at least $2, right? Why? Because like I mentioned, we fix our stop loss and our profit target, and we only take the trade if we have a risk to return ratio of at least 1 to 2. So what happens now? Okay, so I lose $40. I make $120. So you do the maths. What's 120 minus 40? $80. So I know that, you see, whenever I make a trade, I've got no idea whether it's a win or loss. In a short term, I may have a losing streak, I may have a winning streak. That's called luck. Okay? But over many trades, of at least 100 trades, for example, I know I always win because of the statistics being in my favor. I'll make $80. In other words, if I'm betting $1 for a trade and I'm betting $100, I'm getting $80 back. That's an 80% return, okay, in 100 trades, which is about 5 months. Okay? Now, of course, there's no guarantee that you're going to win 60%. Now, what if the worst case scenario happens and you get a string of bad luck, right? And your win rate only goes down to 50%. If your win rate goes down to 50%, it means that out of 100 trades, you win 50, you lose 50, right? But because of the risk to return ratio, the way we rig the market, guess what? We are losing $50, but we are winning double. We are winning $100. So net, I still make $50. Out of $100, that's still a 50% return. So that, my friend, is the essence of how professional traders, we rig the stock market so we always make money consistently at the end of the day. And that's how we grow our income and our wealth. Hope you enjoyed that.
Okay, so you can probably now see the logic why I said that my trading strategy is built around extracting risk and reward from the market. That was a tweet that I sent out. So if you ever see a tweet that you don't understand, that doesn't make sense, just ask. I would just add one point. The guy was suggesting that you could trade a pivot point within a range. It's not something I do, and I've got no evidence that strategy's got a statistical edge. But what I'm hoping that you take away is that win rate isn't that important. That you can actually, if you did the maths, you can actually see that the win rate can be less than 50-50, and you can still make money as long as your winners are bigger than your losers. So hopefully that generates quite a lot of questions, because I've given you something new to think about, something that you might not have heard before. And if I had watched that for the first time, if I watched this video for the first time, I'd probably have 1,000,001 questions on my pad by now. So throw them in the comments. You won't. I'm not going to acknowledge questions on other platforms in future because I forget them and I've got to go searching for them. It's far better if you leave them on YouTube. So you'd be doing me a favour by doing that. So that's it for today. Got any questions? Just shout out onto the YouTube channel.